Okay, everybody. So we'll just kind of get right into it. It's been a pretty interesting week, and I think kind of a pivotal one. First of all, you can see where the treasuries, the yield is down quite a bit, meaning bond buying is up. And if you recall, Bill Ackman said at the beginning, I think it was just at the beginning of the week, he said that he had covered his big short position on bonds, and kind of the market followed thereafter. And I'm not saying he's the guy that sparked it. I don't know, and I don't care. But he does tend to be right a lot at turning points, and so I think his rationale was bonds are getting to where they're pretty cheap, and rates are not going to go much higher with respect to the Fed. So I think it's time to close this trade. But before you get too lathered up, and I've seen, just kind of had CNBC on in the background for a while today. I had a few different meetings, but people are saying like, oh, okay, well, the trend line is broken, and we're going to see rates at 3%, by the end of the year or whatever, which, shoot, I mean, in a way, I kind of hope they are. That'd be awesome. But then in another way, I hope they're not, because the only reason they're going to be that low is if the wheels came off the wagon and the wagon went off a cliff. So it's kind of like pick your poison. But I will just say this, that as yields fall on the 10-year, that's going to be seen as a good thing for stocks, because it's really all about the kind of the risk-free rate of return. And it's been frankly pretty enticing to a lot of people to just be in bonds and treasuries when they're up around 5%. That hasn't happened in a long time, and I have some of mine in that stuff, because I'm like, there's just so many things in the world and so many things look, I think this economy is all bullshit. Frankly, as far as the economic numbers, I think they're all being massaged a lot. But the thing is, it kind of doesn't matter what I think, but it kind of does. And this is my rationale, and maybe this pertains to you. I'm not a stupid guy. I know you're not either. And so I see all these things, and I think, okay, and you'll hear me say this, like, okay, well, this doesn't seem to matter. It doesn't seem to matter. It doesn't seem to matter. Boy, at some point, it's gonna matter, and then that's gonna be ugly. And so that can be kind of my attitude about things. But there's always this thing in the front of my mind, or as they say now, which I'd never heard, top of mind. At top of mind, that's a stupid thing. You're never going to hear me say that again. The thing that I think about most is none of the stuff seems to be impacting the market too much. We got this sell-off from in August down to October, and now it looks to me at least like to use an overused phrase, the bottom is in. It does look like this was, because of various other things, which I'll get to. It looks to me like the market, I think, has made the low of the year. I'll say it. I think that's it. I think the market's probably, the S&P, not going to fall below 4,100. It may continue to run up. We could hit 4,500 by the end of the month. Hard to say. So I'm not going to say. I'm just saying anything's possible. But the thing is, there are a lot of issues with the economy, with the debt, et cetera, et cetera. However, when you really stop and think about them, and you try to put them in proper context, how many of these things can you use for, quote, timing? They're general market conditions. For example, you can be, I'm just picking something out of the air, like you can be concerned about the immigration issue. Okay, fine. Are you concerned about that? Like, do you think something's going to happen today, or next Tuesday, or next month? What's going to be the impact of this massive flux of people? Oh, it's going to be a drain on our budget. It's going to make us bankrupt, which, by the way, it will. But is that going to happen tomorrow, next week, or even next year? Probably not. I mean, not probably not. Definitely not. It won't. So, with that said, is this something that we need to be incorporating into our investing thesis, into our trading behavior? And that's just one example. There's many. You can look at economic numbers or whatever. I just kind of picked that out of the air. So you have to look at this, as they say, the market climbs a wall of worry. Well, there's all kinds of things to be worrying about. All kinds of stuff to be worrying about. I'm worried about a lot of stuff, though I do know that when you worry about what might happen, what you're doing is you're borrowing the problems that might occur tomorrow, and you're trying to deal with them today. So worry only gets you so far and not too far at all. So what I'm saying is that worrying about things is all well and good. We're the only species who actually does worry. I don't know if that makes us the smarter species or the dumber one, but we do. We worry about things. But worrying is not going to make you any money, especially since when we're thinking about this, none of these things that are in the wall of worry are immediate things that you can use to time the market. And like you look at Apple, okay, they reported disappointing numbers. I don't need to go into them. You can read about it all you want. I haven't because I don't care. But what happened to the stock? So the stock gapped down a little bit, like less than 2%, a little over 1%, and then rallied up. So it closed 92 pennies lower than it was prior to earnings. So Apple was basically a nothing burger. Nobody cares I don't care about Apple when it comes to buying any other stocks, and Apple's kind of lost its impact on the broader market. And that's just a fact. So these are the types of things that maybe at one point in the past you looked at this and it's a big deal, like it means a lot. But that doesn't mean that it's always going to mean a lot. And we're at that time when Apple doesn't seem to mean a lot, and there's some issues over in China with respect to Apple, and that's kind of eating into their stuff, their profits and their revenue and things. But there are a lot of things that are going on with Apple that actually don't have anything, at least in my view, they don't have anything to do with the economy, with the strength or the weakness of the economy. I just don't think Apple's numbers are any kind of a reflection of the economy. I think, frankly, and this is just one segment of their market, I think their titanium iPhone has been a total bust. It got the bad rap right out of the gate with respect to overheating to a point where you couldn't even hold it. And then, as I've always said, what's the big deal with titanium? I don't care. I don't care if it's made of Kevlar. I'm going to have an iPhone cover on it anyway, and I guarantee you that nobody's going to be looking at anybody's iPhone and going, ooh, is that titanium? Wow, let me take a look. I got to get me one of them. Maybe it has some other things that are really cool on it, but I don't really see, every time I walk by the Apple store or the AT&T store in my neighborhood, I really don't see a line out the door for it. Nobody cares. And so I do think that Apple's big growth prospects are behind it. And I know what Cramer says. I've said for years, don't trade Apple, own it. And that's all well and good. So if you want to be that guy, go ahead and own it. I have no problem with it. You'll probably make money. But I know this, if you owned it through here, you're down 35%. If you owned it through here, you're down 30%. This is fun. If you owned it through here, you're down 43%. But yeah, just go ahead and own it. Easy to say, tougher to do. And so I just kind of write Apple off. I'll keep track of it, but I just don't see it as being a big market mover. And I didn't feel that way going into the numbers. And I certainly don't feel that way now. I think it's just kind of another stock. So anyway, with that said, I want to look at, I don't want to look at this daily chart. You know, we've been looking at daily charts, and that's kind of the typical time frame you would use for buying and selling. But for analysis, for market analysis and stock analysis, I think it's really important to kind of try to transition to the weekly charts, where you're gonna use the daily charts to do surgery, to actually be buying or selling your stock. That's what you're going to be using the daily charts for. But the weekly charts give you a better sense of what the market is actually doing, what the institutions are doing, whether there's really buying or selling pressure, and how the dynamics between the two are unfolding. So let's look at this. This will give you kind of a different picture here. Like this, I don't know, you can see lower highs, lower lows. Weekly chart, I look at this, and this is what has led me to say what I just said a bit ago, which is I do think the bottom is in for here, because this was a big old sell-off, and then we got a massive reversal just this week of, what was it? It ran up 5.5%. Okay, that's a big number for a major index. It's a huge number. And so if you zoom out, you can see a cup and a low handle right here. So I'm not expecting just to see that, but what I am expecting is for this price level here probably not to be hit again. I mean, what could happen? What catalyst is there that's going to really knock the market down? The jobs number was not good. Of course, they probably sent Jared Bernstein out, one of the biggest shills of all time, to talk about how awesome the numbers are and how Bidenomics is working. Great. Is it working for you? So the numbers weren't good, but this is good for us, okay? Unless you lost your job. But the numbers weren't good. And September was actually revised lower. That's always the case. I said it flippantly this morning. These are what the numbers are. Oh, they'll be revised lower. So September was revised lower, which makes October look better. But the jobs numbers were basically bad. Unemployment's up to 3.9. I think the estimates by a bunch of economists, which are smart people with degrees wandering around lost and in darkness, they're expecting like 3.8%. But think about this for a minute. We're going into the holiday season. Listen to me here. So the Fed knows that the jobs numbers are not good. And so from their standpoint, and the 400 advanced degreed economists that work for them, they know that the numbers aren't that great. And so what are they thinking? Rightfully so. Hey, maybe our job's done. Maybe we've taken it as far as we need to, particularly since we know that all of the impacts, all of the effects of what we've been doing over the last year, or however long it's been, seems like forever, of what we've been doing with respect to our rate hike campaign, the economy really hasn't felt all that stuff. The theory is, and I didn't make it up, I just heard it, that it takes about like 6 months for the effects to work their way through the entire through the entire economy. And so if that's true, or anything even close to that being true, there's still a lot of effect of these interest rate hikes that still has to play out in the economy. And so when you're seeing these weak numbers, if I'm the Fed, and I haven't shot myself because I'm ashamed of it, I'm saying, like, you know what, maybe I better just slack off here for a bit and see what happens, because we got the holiday season coming up. Okay, so the numbers are poor. The Fed says, okay, we're on pause. So what's the market doing? The market's saying, like, okay, cool. For crying out loud, that's what we've been waiting for. That's what we and everybody else have been predicting for so long. How many times have you heard one and done? And then, like, maybe it's 2 and we're through, or 2 and screw you, we're going to 3. How do you like them apples? But now with this, we could be like, well, yeah, the 1 was this last one, and now we're done. So the market can look at these tepid numbers as a good thing. So then that takes us into the holiday season. So what happens, and there are people that are expecting shopping season to be really, really good this year. And maybe it will be. I've never been able to game that stuff. But so maybe the shopping season will be really good. Okay, well, so what's that going to do? Then the market's going to look at that and say, hey, man, this is awesome. Soft landing. The Fed's probably done, and people are still buying. They have no money. They're spending everything they have. They're maxing out their credit cards. Awesome. And so then stocks go up. On the other hand, if the holiday season is not so good and the numbers are poor, well, that's awesome too. Because now the market, instead of looking at at the strength of the consumer and how it's, all systems go, now they're looking at, the economy is, well, you know what? Hey, we thought about this. The Fed's definitely done now. They're definitely not doing anything else. And so that's good for the market. So we're kind of in this situation where, I'm not going to say it's a Goldilocks scenario, because I don't want to offend Goldilocks, who's actually a fictional character anyway. But and I think she's still a female, but we don't know these days. Anyway, I digress. So I'm just saying that it's kind of like, I don't see anything that could really be, absent some surprise thing, geopolitical, obviously that kind of thing. But I don't really see anything that's going to make people rush for the exits. And that's what I feel. That's just what I think 18 minutes into this. And I probably should have been on camera, so at least we could be making eye contact. But that's the way I think. So let me move on. Okay, so transports. Again, we're on the weekly. No, nothing good happens when you're below these key moving averages. You look here at the S&P. Yes, it's below the 50 right here, but it's it's starting to push right up against it. And I'm not talking about trading the SPY anyway. I'm talking about this pattern. That's really what we're talking about here, is this pattern. So I don't want you to go, oh, well, this isn't a good entry. I'm not talking about trading the S&P, but we look at this as to get a context of what the rest of the market's doing. Transports, no thanks. Mid caps, no. This is a reflection of the cost of money and the fact that small companies are having a really hard time finding money because it's no longer free. And so we're going to see this type of weakness for a while. Now, the Qs, to me, this is really interesting. I don't know why. I guess I can look at it and see. Okay, see, you see how this has, kind of a steeper angle. The Qs, not quite so steep. Now, this isn't a big deal. Maybe it's just kind of a minor point, but to me, this just looks different. This just looks stronger. And so I just like the way this is setting up. And I think we can run up to 390 or so. And this is the NDX, the NASDAQ 100. I I don't know why this can't go up and test 16,000 again. That's what I'm looking for. And I actually did take a small position. This is a kind of a placeholder position, as in like better than cash. I took a small position in QLD because I like the way this looks, and I think that I think this can get up to 70 without too much trouble, and that's a good trade. I'll take it. Nvidia is, as you know, they report earnings on the 21st, so I think people are going like, for Christ's sake, can we hurry up and get there? I just want to know what NVIDIA's doing, because it matters. And yes, it does, but this is another thing where I want you to be thinking about this. The numbers that NVIDIA reports are they're not a reflection of the economy, good or bad. They say nothing about the economy. It's more about AI and their graphics processing units, just the demand for all that stuff. But then there's the I forget what you call it, where the government's not allowing them to sell this stuff to China. And hey man, China pays money. They not just to our politicians. They pay a boatload of money to our politicians, but they pay a lot of money for this stuff too, so that they can steal it later. So this is definitely going to have NVIDIA is going to have something to say about that. But don't think that that's going to be any kind of a reflection of the health of the economy. It's not. But I wait for this, because I could see, so far I've been right about this, though some people would say I've been exactly wrong because they don't listen to the nuance. But I've said before, like, hey, I like NVIDIA. Mentioned this before, that it could go to 500. And then I said, if it breaks through 500, then we go a lot higher. But if it doesn't break through 500, hey, I could see it going down to 400, maybe even 350, which wasn't a prediction. It was, well, you see it here. It wasn't a prediction. It was just based on the chart and looking at the moving averages. This was on 9/20, 22nd, like right here is when I mentioned this. So why did I say that it could fall down to 350? Well, I'm just looking at the way the 200-day moving average was moving, and the fact that a stock's not just going to drop like that. And so if you just kind of use some, and you should be thinking about doing this in your own charting, if you just use some common sense and remember that it takes time on the x-axis for a stock to do whatever it's going to do. And so when you're looking at a stock as far as where it is, and you're saying, okay, well, I think this thing can decline. I think it can really start being under pressure. Okay, well, how far can it go? Where are the moving averages? It's a mistake to look at a moving average and say, oh, that's where the stock's going to bounce. No, because the stock's not going to bounce there, or not bounce there today. You have to give it some time. You have to look at a chart and say, if this 400 breaks down, is it going to go down to 350 or 320 like that because this is where it is? No, you have to extend. That's why I draw these lines, extending this, so I can kind of look out into the future a little bit and see where a stock is likely to find some buyers if it blah, blah, blah. In other words, everything in trading is a hypothesis. It's a hypothetical. If this, then that. But if this, then that. That's your thesis. That's your hypothesis. And you have to have those. Like I say, it's important to have an opinion about something, but you don't want to be dogmatic. And the reason is because if you have an opinion about something, you know what at least you think a stock is going to do. Okay, well then when it doesn't do that, you don't look at it and go, bad stock. No, you say, okay, this is good information because I thought it was going to do this, but instead it's not. So what is that telling me? This is the type of thing that you really, really need to know if you want to progress in your trading. And they're actually simple things, and they're easy to understand, but as with a lot of things, they're only simple and easy to understand after they've been explained to you. That's what the nature of epiphanies are. At one point you go, oh, okay, I see it. I didn't know that. And that's kind of where we are on this. Okay, let me get going here because I got a weekend to get to, and so do you. So Novodisc, still chopping around. This is really gappy. It's the only stock that's on the active trade idea list. I got to mention this though, just so you know, because it's really important for newer members. The active trade idea list, sometimes that thing will be chock full of stocks. Other times it won't have any. Typically it's somewhere in between. But those are just trades that I look at. Like I'll take more trades than I put on the list. And then sometimes a stock that I put on the list, well, I missed that trade. I was doing something else. But they're just ideas. That's why I call it the active trade idea list. But if you look at these, like I'll give you a bunch of stocks that are definitely buyable. But it doesn't mean that I'm putting them on the list. So the reason I'm saying that is that if you're going to be getting the full value out of Stock Market Mentor, you want to be watching my videos and you want to be watching Scott's, because that's a great value here. At least I think so. If I didn't think so, I wouldn't be doing this stuff. I'd just be putting a bunch of stocks on a list and learning to golf. But so you got to pay attention and learn all of this stuff. But also the whole idea of the active trade idea list is to give you kind of some templates and some examples of trades that have sound entries and exits. That's really what it's all about. For example, on this one, I mentioned this before, I feel like I made a mistake here in suggesting that it be bought here at the 50-day moving average when it came down here. And then the next day, and I had a stop down here, so we're fine. We're up on the trade. But I was anticipating the stock doing that. Okay, well, this is a gappy stock. Okay, it's an ADR. And so you wake up in the morning and, hey, man, it's a different world than it was at 4 o'clock in the afternoon yesterday. And so you'll get this kind of stuff. And in hindsight, I should have said, okay, it looks like it's going to rebound, but I'm going to wait. And so then the next day it comes down here, and then I might have still said, you know what, I'm going to wait. And then I'd have probably, if I was really bound and determined to find an entry here, this would have actually been the entry 2 days later at a higher price. So this is the type of thing that I use that active trade idea list for, to kind of dissect trades and avoid the situation where people are here going like, oh, I just want to trade the active trade list. Okay, you could do that, but try to have your head in the game and see if you can learn something out of it, get something out of it, okay? So let me move on. Now, crypto, only two things we can trade with respect to cryptocurrency is Grayscale, Bitcoin, and Ethereum. Okay, they're both in really good uptrends. I'll just put it that way. Not great entries at this particular moment in time, but they're in good uptrends. Now, check this out. I like ServiceNow, like right here, right now. This is, you can see like boom, 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 a continual push against 600. You know, we saw that. I initially drew that line here, and my sense was, hey, if it pushes above this and holds, then we're in the army. Then we got higher prices. So we need to be looking at this on Monday, because this could be one of those things where, okay, this is kind of a breakout entry. It's a typical investor's business daily type of thing. You know, oh, it's a breakout. The thing's gone to the frickin' moon before the breakout, but here it is in the breakout, so we got to buy it because that's what Bill O'Neill would have done. And I have no criticism of that. It's just I kind of like to buy tighter patterns closer to support. So this isn't really the type of trade that I would just naturally make. However, I'm not the world's greatest trader. I'm just the only one that would admit that. And so I make errors all the time, and I miss things all the time. So this could be one that I might miss. But the way I'm looking at this now, if this stays above 606, I think this could go to 700, frankly, pretty darn easily. So at least that's what I think. Now, so the cybersecurity, remember a few weeks ago, I was kind of harping on the fact that the only ETF that was still kind of up, that was above the key moving averages, was HACK, was the cybersecurity ETF. And the market's picked up since then. But a couple of these are still definitely worth looking at. First of all, if you look at Fortinet, you know, they reported earnings and everybody made a lot of it like, oh my God, it's over. But look at what happened to the stock. Okay, oh my gosh, it's down 12.5%. Well, that sucks. Does it really? Because the stock opened up down almost 23%. Okay. Oh, but it only closed down 12 or 13%. Okay, well, that's good. Yeah, that's better, right? But this is the best, that after it opened, it ran straight up. And this was like a 13% move right off of the bottom. So this was this was a textbook 59-minute trade. Like, buy this, you can even be buying it the way it was trading, like right off the 1 minute chart. And then going into the 10 o'clock hour and a little after that, you know, you got 7, 8, 9%. So this was a good trade. Well, what is that telling me? It's telling me that Fortinet had a nasty quarter, and there's a whole boatload of resistance over there. I wouldn't buy this stock. But the sector isn't dead. It's just stock specific. CyberArk, this is an Israeli company. Weekly chart looks just fine. Big old long cup. We've looked at that before. CrowdStrike, nice uptrend here. Weekly chart, daily chart shows a big old mess here. If the stock can get back to the 50-day moving average, that's where you want to be buying it. I think the stock works. DraftKings weekly chart looks pretty solid here. That's the pattern. I would want to see a breakout above that. And you can see here on the daily chart, I think they reported earnings or something. Everybody's doing the DraftKings thing except me, I guess. I trade stocks. That's gambling enough for me. But this was a big move. You wouldn't want to buy it here, but definitely this is one to watch on the weekly. Now, remember on semiconductor, which I covered, this is kind of like the classic 3-day rule, where it's almost kind of a reverse. But, you know, the big money makes the move happen on the first day. That's this, okay? The semi-big money, and this is like the smart money. Well, the smart money sold up here, but the big institutions, they made this happen. Up 40 million shares. This wasn't Bill and Jethro that were selling their 100 shares. So they make the big move here, big, massive volume. Look how much volume this was. And then the second day, those that didn't sell on the first day but are still kind of white-knuckling it, they finally give up the ghost. They sell. And then finally on the third day, who's selling? The wrong way Corrigans. Guys that held through this thing all the way down, and then finally on the third day, when it gapped down like a penny or whatever, like this closed at 62.64 and it opened at 62.50. So it opens 14 cents lower than it closed the prior day, and everybody that's remaining dumps their stock. And there are buyers, they're waiting with open arms, trading faithfully. and because they're not going to stop believing in the stock. How's that for a journey trilogy? Anyway, and so this is what you got to be paying attention to. On these big stocks that make nasty moves like this, it's a different kind of trade. You look at this and say, okay, this is what I would call a rubber band trade. Like the rubber band stretch so stinking tight. We can take Bollinger Band width down to 3, and you'll see the stock was even outside 3 standard deviations, which is a felony in the law books of statistics. So this was actually a good trade to the upside. And by the way, this is one that I mentioned, and I know a few other people were on it as well. So anyway, look, that's all I got for you. A little bit longer than usual. I hope you all have a good weekend. But just, again, keep something in mind to go back to what I was saying at first. There are a lot of things to be concerned about, and I'm concerned about a lot of things. But it's really important as market students of the market, it's really important that we make sure we differentiate between points of worry that can influence markets right now, because that's really what matters. You can't take action tomorrow. You can only take action today. And you have to wait for tomorrow for that to be today. So my point is, are things that you're worrying about, are they things that you're going to have to take action on today? Are they things that you're looking at going like, oh my gosh, that's really going to knock down the market. This is horrible and this and that. Okay, yeah, but is that what's happening? Because this is the hard truth about trading. We are all hardwired to lose money. It's not fear and greed so much. It's fight, flight, and freeze. And when your positions go, like, think about it if you're an alien. I don't mean the kind that came across the southern border, but somebody that came from outer space or wherever they come from. They're here. They're among us. At least I think. Anyway, I don't really. But like you're an alien, you're going like, wow, this is really curious, man. These guys, I'm looking over, these guys are looking at these damn charts, and they're clicking their mouse, they're doing stuff. And they see the buys and the sells. Okay, well, here's what we're hardwired to do. We're in a stock, and when it falls a lot, what do? We panic and we sell. Why is that? Because we're so afraid that we're going to lose money that we make damn sure that we lose money by selling our stock. Because what was really the case, we got freaked out because we're down 5% or 8% or 20%. We got freaked out by that. And so we're concerned that we're going to lose even more money. And so what do? We sell. And then what happens? And by the way, everybody does it at the same time. That's why they're called climax bottoms. What do? Then we sell and the stock goes up. And then the same thing happens on the reverse. A stock goes up and up and up and up, and it's without us. We're not buying it because it's gone up too much. It's gone up too much. It's up too much. It's up too much. I can't buy it. And then finally, I got to buy it. That's what happens right here with NVIDIA. When it gapped up on earnings, everybody bought the stock because, oh my gosh, the numbers were awesome. So they bought the stock. And then, of course, you know what happens. Then the stock comes down and probably selling right about here. So, you're one of these little people with the weird looking eyes, and you're looking at somebody making these trades, and you're trying to figure out what they're doing. And then you finally realize, this is a real curious species. I know what they're doing. They don't want their money. They're trying to give away. They're trying to give away their money. So they're exchanging their money for a stock. And then when the stock falls a lot, then they say, okay, now I want my money back. And so then they exchange the stock for the money, and they have a lot less than they did before they made that exchange. And then, they sell the stock. So they're with money, and then they wait for the stock to go way, way, way up. And then finally they go, oh, okay, this is the time I can exchange my money for that expensive stock. And they do that, and then the stock goes back down. And these curious people do it again and again and again until they don't have any money. But here's the weird thing. When they run out of money, they're sad. And I don't understand that, because it sure seems to me like they won the game. They won the game that they were playing. Okay, that's the end of that silly story. But when you think about it, isn't that really true? Isn't that the way we are wired? And so what we have to do as traders, if you want to develop and become better at what you're doing, you need to understand that hard wiring, and you need to develop some rules that will kind of bypass that hard wiring. And you also need to apply those rules with sufficient consistency that they ultimately just become new hard wiring for you. And you can't do that in one or two trades. You can't do that in one or two videos with me. It has to be something that you do by yourself on a very regular basis. The best traders, at least the best ones that I know, are actually very thoughtful. They have very high sense of self-awareness, because they know that the way to make money has nothing to do with the stocks. The way to make money has everything to do with what they do in reaction to what stocks do. So self-awareness is a heck of a lot more important than understanding how to read charts. If you're really aware of your own tendencies, I could teach you everything you need to know about trading in about 20 minutes. It's all the other stuff that can take us down. So anyway, that's all I got to say. I hope some of this resonated with you, and I will see you Monday.